Because we're live. Well, it didn't do the intro music like it normally does. But hey, guys, what's happening, y'all? Christopher Griffith here, and I've got Hammer with me as well. If you recall, last week we talked about where the market was, the mortgage market. You hear that weird noise, Hammer? Is that your background?
You might be. They're working all the way in the front of my house on my deck, so that may be what you're hearing. Again, perfect timing. You've been quiet all morning. It'll start up just as we start.
Well, that's no worries at all. Sorry. Awkward start because usually there's like an intro thing, but Nathan's not on here just yet. I'm sure he'll hop on here in a second. He's usually producing them. But we want to bring some information to y'all guys and gals in here on what's going on with the mortgage market as far as interest rates this week, what's impacting those, kind of how it drives them, why it drives them, so y'all can understand a little bit about what you're seeing out there as far as the main movements. Now, keep in mind, every company prices their mortgages separately. They all determine through their risk thresholds and everything else and what they want and what they need to keep the total profile of risk down, right? But they all price their loans separately. So what we want to talk to you about is just the fundamental movement behind the mortgage interest rate markets and the things that drive it. So Hammer's a good friend here. He advises a lot of different professionals in our industry on this same very topic. And so I've asked him to come on as a courtesy and visit with y'all a little bit and hopefully explain things in a little bit more of a, I want to say Barney style, a little way I'll understand, right? It's not rocket surgery completely, but it's pretty hard too. So Hammer, intro yourself if you want for a second and kind of let everyone know what's going on.
Hey everybody, all the intro I need is what you just gave me there. So with no further ado, let's talk about, I'm going to see if I can go ahead and share my screen and see if this does pop up. Are you able to share that screen, Christopher?
Oh, that's a good Nathan question. Hold on, let me see. I can.
While you're playing with that part, let's talk a little bit about what we got going on this week and what's going to affect mortgage rates. So this week, we really have two events, and one is actually linked to the other, and they're going to have the biggest effect on mortgage rates this week. So there we go. Awesome. Fantastic. So got a little bit of slides up there. Nothing pretty, but just something for you guys to look at as we're kind of talking through this and kind of explain it. So this is just a quick overview in 1,300 characters or less of what we expect to happen this week and why. So for this week, quick recap on last week, mortgage rates are just a little bit better. And like Christopher said, when I say they're better, it doesn't mean that you've seen rates necessarily drop and the rates you were quoted would have improved, but it means that across the mortgage industry as a whole, we've seen a little bit of improvement on what drives mortgage rates. And oftentimes your mortgage professionals and your lenders will be able to pass those along to you in a small form that we call rebate pricing. And rebate pricing is basically the credit that you get when you pick a mortgage rate or the cost of what it takes you to get a rate if you want to buy that rate down using what's often referred to as points.
Right, so pause there for a second. So if y'all are following, like, well, what is that? Here's what it is. Even if the interest rate offering doesn't change necessarily from one day to the next, the credit or cost to move up or down or what you get back from the lender, right, for a certain rate chosen, that thing may change and migrate a little bit. And that sometimes can be to your benefit or small to your deficit. And that's what he's kind of talking about here.
Yeah. So overall, what's nice is that rates are relatively unchanged. So you didn't have to worry about waking up one morning and seeing that mortgage rates had jumped or that if you had locked in, you don't have to worry about rates have gotten significantly better. But this week we could see a lot more volatility because there's two big events that are going to affect mortgage rates this week. And the first one is going to be on Wednesday. So starting tomorrow, the Fed will be meeting in what they call the Federal Open Market Committee meeting. And basically they're going to get together, the Fed and the Fed presidents, and they're going to start voting on a few different things that are going to greatly affect our economy, and they're going to affect mortgage rates. So the first thing they're going to vote on is what they want to keep the Fed funds rate at. Now, the Fed funds rate is like it's like the little engine that could. It is just this little quiet behind the scenes interest rate, and it's actually the rate that banks lend each other money at overnight. And in fact, I did have a little bit of a Investopedia article here for you so you guys can see that. So the Fed funds rate is basically, it is the fee that it's the guidepost, if you will, for what banks are going to lend each other money overnight. And the reason that banks lend themselves money overnight is because they have to have a certain reserve requirement according to what the government has set in our federal our central banking system, the Fed, has set in order to protect depositors and make sure that there's enough money for if there's ever a run on the bank. So they have to meet these requirements, and in order to meet these reserve requirements, they may have to borrow money, and they borrow money from each other, and the Fed sets this rate. So it really doesn't look like it would be that important of a rate. I mean, why does it matter what the banks lend each other money at, overnight? Why is that a big deal? But the Fed funds rate is actually the basis for almost just so many different rates out there, especially short-term interest rates. It's your auto loans, it's your student loans, the prime interest rate. The prime rate is based off of that Fed funds rate. It's usually about 3%, 3.25% higher. About 3% higher than what it is. So when you have that prime rate, that's all based on that Fed funds rate. Now, the Fed is not expected to adjust that Fed's rate yet. And ever since the pandemic, we've seen the Fed keep that interest rate all the way down to 0 to 25%. What that means is that they are trying to stimulate the economy as the pandemic hit and make sure that the economy didn't fall too far into the arrears, if you will. It didn't slow down too much. So now the concern is, when is the Fed going to raise that rate again? When are they going to start to try to slow things down as the economy has been recovering and heating up? So there'll be a lot of eyes watching that meeting on Wednesday. The reason it's Wednesday is it's a 2-day meeting, so it concludes on Wednesday, and that's when the Fed is going to release their policy statement. And we'll talk more about that in a moment, and as far as the interest rates. But the second thing that'll happen is, shortly after that announcement, then Fed Chair Jerome Powell is going to go ahead and he's going to do his press conference. And that's usually something that has a pretty significant effect on all of the back end factors that help set mortgage rates. And we'll see some reaction in the markets. And there's a lot of volatility. So on Wednesday, it could be a day where you may see lenders that actually change their price in the middle of the day. And we call that repricing. And generally, what'll happen is you might check mortgage rates in the morning, and then in the afternoon they'll be different right within the same day. And that's actually because of the volatility in that bond market with mortgage-backed securities and the basis of mortgage rates. So we want to be aware of that on Wednesday and be careful. And it's a good day to stay in touch with a mortgage professional if you're working with on it, or to watch what's going on in the markets if it's of interest to you. And as specifically,
so let's make it interest to them real quick. So for those of y'all that are purchasing or refinancing or doing something where you're in the point where you're like, okay, do I lock? Do I not lock? What do I do here? In general, I'm a fan of, as soon as you're in a position where you need to be locked, look at the market for par, what it is, compare the lenders and everyone for where they're at that very moment, same moment in time, with the same site picture, same site alignment, right? And lock them if you got them, right? Lock what worked with your scenario. Don't chase things through the woods, hoping to get down and save an extra 0.1% on your interest rate at best, maybe, or lose a little bit, right? But if you see a scenario that works, it's usually advisable to lock it. Helmer, would you agree or disagree with that statement, especially in the context of this week?
Absolutely, for this week. Yeah, there's certain times that, based on the overall factors, the trend is that rates are improving and you don't need to be in a hurry to lock, maybe because you could pick up a better interest rate by hanging back and waiting. This is not one of those times. It's very unlikely that we're going to see rates improve, and even more unlikely that they would improve significantly. In other words, we may see a little bit of improvement to those closing costs that we talked about, that rebate pricing, but it's very, very unlikely that we'd see interest rates improve from here because of inflation and because the Fed is going to have to take action soon, and that has interest rates getting ready to rise. So I would, locking in is a very, very good decision right now.
So when you say because of inflation, and that means the Fed has to do something soon, talk about that in a very rudimentary layer. What does that actually mean? Because I get it and you get it and a lot of others do, but it's not the easiest thing to understand, and I didn't come to understand it overnight either.
Right. So without getting too deep in the weeds, what you want to recognize is the Fed's job is to do two things as a mandate. The Fed is mandated to maximize employment and to keep inflation at a rate of about 2%, because some inflation for the is healthy for the economy. We talked about that last week. So in order to meet those mandates, the Fed has that Fed funds rate to manipulate. And they've also got some other tools at their disposal, one of which they used during the pandemic, and that's called quantitative easing. And quantitative easing is a fancy way of saying printing money. So what the Fed's been doing is they've been printing money, and they've been buying up the certain amount of the inventory of bonds in order to keep rates low. And now they're talking about, okay, it's time to ease back on that. And they call that tapering. So the Fed is going to reduce monetary stimulus, meaning that they no longer have to push the economy to improve. The economy is picking up steam. It's improving on its own. It's recovering from the pandemic. So now the Fed is going to start to remove these tools that they've used to keep things going, one of which was this quantitative easing. And because of that, investors are now worried about, well, if we can't borrow money cheap, if things are going to get more expensive, profits go down. And that's what tends to kind of ripple through the stock market and ripple through the bond market, and eventually find its way to mortgage rates and pressuring mortgage rates a little bit higher.
Cool. Hey, guys and gals on the thread here too. If you're watching the video and you have any questions specifically, no dumb questions. Yeah, we had a post last week. A lot of y'all interacted with it. We had some great questions. People that they were asking dumb questions that weren't dumb questions at all, right? Ask your questions if you have them, especially when you have placement access and audience with a person who can answer them with specificity, right? I do think one thing's worth noting. The last time we've been in a circumstance kind of big like this, I think, especially with someone that was different, I think that from Powell, I was reading a little bit of stuff on this morning, and I do recall it as well, but Bernanke handled it, I think, a little bit differently, and he was probably a little more abrupt in his announcement. And I think it's at least worth noting that as far as volatility and how volatile things can and will be, a lot of it being based off of what he says at the press conference, right? You said on Wednesday? Or was that Thursday?
Yeah, the press conference is going to be on Wednesday, 2:30 p.m. Eastern time.
So when he speaks, it is somewhat important to note that he's been speaking exceptionally cautiously and in a way that hopefully doesn't torpedo market sentiment and emotion, but instead provides an outlook and a measure of cautiousness to cause them to relax a little bit. Is that sound statement or what? What's your opinion on that?
Yeah, well, actually,
it matters what they say and how they say. It matters a lot, right?
It certainly does, and it's funny because just a word here or a word there will lead to speculation. And for traders, for investors, they're trying to act ahead of the pack. That's the only way that, not the only way, but that's their best way that they're going to make money. They want to act first. They want to beat the masses. So they're really looking for these clues, and they tend to kind of jump the gun. And that's why we're going to see that volatility. And what I just put up on the screen for everybody is this is a really cool tool to look at. And it gives us some insight into basically how is the market handicapping when they think the Fed is going to start raising that Fed funds rate. And when that Fed funds rate goes up, it's going to push interest rates up across the board, not because it's directly controlling them, but because they all base somehow or another, they fall back to basing off of that Fed funds rate. So right here is a 100% chance that we're going to see the Fed funds rate stay at the 0% that it is right now. And everybody believes this means that all of the markets are basically thinking, hey, we're going to see things stay just like they are. There's no chance at all that we think the Fed is going to raise rates in November. Now, we've got one more meeting this year, and that's in December. So in December, the markets currently think, hey, also, we're going to see rates stay exactly the same. There's 0% expectation that the Fed is going to raise rates either at this meeting in November or at the next meeting in December. But once we start getting into 2022, that starts to change. And now you see that there's a probability. And again, this is like if you were betting on a football game. These are all probabilities. This is your betting line. So there's 95% out there that think we're going to see rates stay the same, but now we start to see 5% say, hey, we think we're going to see at least a rate increase. Rates are going to go up 0.25%. And as 2022 goes on, we can jump to the March meeting. There's a big jump. And you could see as we go later in the year, we went from 95% to now it's only about 75% that think that rates will remain at zero. The rest believe that we'll see at least 0.25% increase. And as we go into May and June, you're going to see these numbers get lower and lower, 65%. As we get to June, now it's 35%. So more of the market is handicapping that we'll see our first rate increase from the Fed by the middle of next year. And whatever the Fed says in their policy statement, and especially whatever Jerome Powell says in that press conference, investors and traders, they're going to be looking, does this kind of go along with what they currently expect, or does it change their expectations?
Oh, press conference. Is it like a press conference with like some hard-hitting questions with people that know how to ask like what questions specifically, or are they like lay them up with an teleprompter kind of a
there's a little bit of both sometimes. The press conferences are actually available live. If anybody wants to see them, you can actually see them. They're on YouTube, and they're done by Zoom meeting right now because of the way that things run with the pandemic. So you have different members of the press, and Jerome Powell will, Fed Chair Powell will actually give a prepared statement, and then he will start to take those questions. And generally those questions will be specific to whatever he said in his statement. They'll look for clarification, or they'll sometimes the questions really have a tendency to try to steer him to release more information than maybe they're prepared to do. And that's why we are I'm looking for the word. We're so secure in the idea that the Fed is going to go ahead and announce that they're going to start reducing monetary policy. This meeting is because of the questions that were asked at that last press conference, and where the Fed said, okay, this is what we think is going to happen. And Powell was very clear. And actually Powell is much more transparent than like Bernanke was. So in the past, the Fed was very cryptic, and it's this balance that they play, and they try not to give too much information. And Fed Chair Jerome Powell, he has a very different approach, and he's actually very transparent, and he talks very freely about what the Fed is looking to do. So these questions are actually very insightful because you get really good responses from them, and everybody's going to be looking for, when do they think that we're going to see what they call liftoff, and that's the Fed to raise rates. And right now, the markets really believe that that's going to happen by the middle of next year. If Powell were to say something that led the markets to believe it would happen sooner, markets would react very quickly. They don't wait until they think rates are going to go up. They react now so they can get ahead of everybody else. And that's why it can be so volatile based on how everybody's speculating.
Awesome. No, I appreciate the breakdown there. And I think it definitely has significance, since it literally hangs off of every word they choose to use. And words are hard, right? Sometimes words are hard. So there's a question here, and I'm really actually curious. I was getting ready to tee off on it, but I thought, this might be curious to get a markets guy to answer from this perspective. The question is, I'm going to go ahead and put it up. Is there a mortgage broker fee? So we're on here talking about the mortgage interest rate market, movement market, regardless of whether you're using a mortgage broker, a mini correspondent lender, right, which is a little different, or a full retail lender, right, like USAA, Veterans United, or regardless of whom you work with. These are the fundamental movements that impact all of them, right? That they all base their product, off of, that is what you compete with, right? And so they all get paid differently because of the channels that they're in. But I'm curious, Helmer, how would you answer that type of question as a mortgage guy?
Is there a mortgage broker fee?
Yeah.
It depends on, it's hard to not answer everything that you just said. It depends on which channel you're working with. But for VA, aren't the fees that can be charged to the veteran pretty set?
Yeah, that's a great point. Yeah, they're capped as far as origination and discounts that can be chosen along those things, right? But I think that the idea here, the thought is, if you work with a mortgage broker, you're working with someone that's a middle guy, and so they add on or tack on an extra fee that doesn't exist elsewhere because of that, right? That's the common kind of, when I see the question like that, they think that there's a fee for a mortgage broker that's separate and above or attached to, that doesn't impact their product that they offer the consumer in the same way it does every other place that they could get a mortgage.
And that's certainly not the case, though, as we both know. That fee is usually worked into the transaction, and the costs can be lower for lenders working with a broker. So sometimes those that can be reflected as better interest rates, and sometimes not.
Hey, and I've got an idea. Boom. Look, there's Nathan Nottingham, our local Mother XO, and he was formerly a compliance teacher. And this actually falls under the LO compensation rule, because a broker, right, whether it's the entire brokerage or the originator, is impacted by LO comp rule. So Nathan, from a compliance angle, what do you have for the folks with a question like that? You're on mute. Oh, I love that cliche this year. Can you not unmute yourself?
I got it. No, it's good. I didn't have my mic set up either. I wasn't ready. Gosh, I appreciate it though. Is there mortgage broker fee? Yeah, wow. From a compliance perspective and what we're talking about here, look at your LE, your lender. Everybody gets paid to do a loan, right? It's just how much can they get paid and from whom and from when and where. And so is there a mortgage broker fee? There is rarely a fee. Sorry, I'm just going back in my head. There's not a fee that's not disclosed that you have to pay. So you should see this out front. Now, a broker is going to get paid. How deep are we going down this rabbit hole, Christopher?
Yeah. I was going to say, because they may get paid by the lender, and that's disclosed, but it doesn't.
I think it's really complicated here, guys. Brokers get paid either through something called a LPC, right? A lender paid compensation form, where their fixed LO comp plan, right? Their fixed plan, whatever their profit margin is worked into the regular pricing, and everything goes through that lane designated channel, right? And as a broker, I can't just say, oh, wait, I want to increase it on this loan. It's fixed. You can't do that. So brokers set their compensation based off of how they need to be competitive within their market, based off of a lot of things: loan amounts, loan products, right? Interest rates, many different things affect their ability to compete, but they compete with the same categorical baselines: interest rate, right? Origination cost, what would show up in your box A, right? And then on with credits, right? And discount points that are available. So those pricing, whether it's something you have to pay because you're working with a certain channel, right? Some lenders out there charge additional origination to do loans. Brokers can't make, for instance, their regular comp and then on top of that receive income potentials from other categories too. It doesn't exist that way for us, but they have those same potential charges if they modify from an LPC or a lender paid comp plan to a borrower paid comp plan. This is something that's allowable for brokers when they compete or when they get into a situation where they're trying to compete for business in a way that because there's something out there significant or substantial with usually a temporary product offering or something along those lines, right? And that's where it switches from the LPC product, that the comp plan that they normally have in place that's fixed, goes away. They don't make money in that channel, right? And every bit that they can make is fixed into the origination bucket, right? Well, that bucket exists capped to you at 1%. And so now all of their profit must exist in that 1% category, right? If there's an allowance to push to that, right? Because they can't be picky and choosy about who gets access to what types of products and everything else. But it's the one way that that the regulations through Dodd-Frank and everything else, right? The LO comp rules have allowed brokers to compete off of the one fixed thing that they have to do. Everyone else can be willy-nilly picky or choosy for whatever reasons, what they want to, up and down, however, right? Well, brokers can't. So they're fixed in place. And when they do that, they're all in that 1% bucket, which exists for those other people as an additional means for profit, potentially. Not that they all do. It's not that companies are bad or that people are bad. It's that their options and the access to different options for y'all's sake, or considering your perspective first, are different. They're all priced differently. So how those things exist for you are all the same, though. You look at the loan estimate or the closing disclosure, and you compare categorically same-day pricing for the rate, the cost for the rate, right, the closing costs and fees, the discount points charged to get to that rate, or the lender credits given at that rate, and you compare them across the board, right? It's because that's the perspective that informs you of how they all stack up, right? And that's the thing, just so y'all know, a lot of veterans in here post a loan estimate and they're like, hey guys, is this even competitive? Every day our moderators pick those up. They have private dialogues and they just tell them the truth. It's not a sales function. That's not how they exist with y'all here. I think y'all know that at least by now, but it's just to inform you on how things are competitive or not. We have a lot of data, by the way. They're getting ready to drop on this to show you, because you don't know until the year end how all of these banks and all of these companies that originate and issue VA loans, how they compete for y'all's sake from what you see and feel. Well, after a year, we do, and we have data on it. And I collect data that doesn't apply to your identity in any way, but product identity, the same information they have to report to these public places, right? For all of the moderators here on every single thing that they do relating to VA. And so this allows us to compare and contrast them individually, internally, and externally to make certain that they're competitive. And we don't allow for those that aren't, right? But you'll be able to see some of what we've been working on through the VTB, or the Veteran Tangible Benefit collection process that we have, that'll help to break down what you're inherently asking. Is there a fee? What's the cost difference for working with a broker? That's what you're asking, right? And so how you see that is by looking at the same comparables for those products. That was kind of a long-winded explanation. Hopefully I answered the question well. How do y'all feel that I handled the question?
I think it was long-winded. No, I'm just kidding. It was a very thorough explanation. What I would piggyback on that, though, is whether you're working with a broker, anybody that you're working with. Christopher hit the nail on the head when he said you want to look at those rates at the same time. And this week, I think you're going to really see where we could, if you had a conversation with somebody on Monday and a conversation on Friday, you may end up with very different conversations. And that's probably the takeaway we want to keep on this conversation, is that this week is a week that could be very volatile and could be bad for mortgage rates. And if you like what you've been quoted, you may want to make that decision sooner in the week, especially before Wednesday. Now, last month, the Fed met and they met on they released their statement, and that day things kind of were up and were down, and then they settled down, and it was like this calm before the storm. And we were like, okay, that wasn't so bad. Rates are doing okay. And then the next day, rates just jumped. We saw a quick movement in rates. In fact, a lot of lenders, they went up about 0.25% in interest rate just in that one day after the Fed meeting last month. Now, past performance doesn't mean about future performance. You guys know those disclosures, and that's true here too. But that possibility is certainly there this week.
Here's what he's saying there, vets and active duty people. Normally, it's like this for you with interest rates. It's like your interest rate is just out there in the middle of the field, the target of opportunity, just kind of hanging out, bobbling around. This week, it's going to be, I'm up, he sees me, I'm down. I'm up, he sees me, I'm down. Right? Your interest rate opportunity with what you're going to want and need. If you see it, take the shot, ladies and gentlemen. You should be informed. We've taught you and shown you in many posts over couple years here now how to compare these things and how to see the values that exist for you. And you know what works and what doesn't work with your circumstance, which is what we always advise to y'all to consider in how you shop and how you compare your stuff. So if you see what works this week, as we said in the beginning of this thing, squeeze, pull the trigger, lock that sucker, right? Because as soon as you do, your circumstance is provided for, and you know it's done so in a way that is appropriate to what your needs are and what your entire, left and right lateral limits were getting into this thing were. And that's more important than not knowing for sure. In the future, if things get worse or get better or whatever else, new opportunities may exist, but don't get so hung up on perfection that you fail to squeeze and take the right shot when you need to, and you get less opportunity for it later.
I think at that point too, I would say to Helmer's backing, as we do these more regularly, we kind of create a standard cadence of these kind of conversations. People tracking will notice that the markets do this, right? And they do this a lot.
Yeah,
and so many people that we get comments of on our pages are asking like, hey, I'm building, when can I lock my loan, right? I'm not going to close on this purchase until way down the road. There's reasons, and that's going to go into, hopefully this provides a little bit more why than even a loan officer may stop and talk about, but there's reasons why a lot of lenders won't allow a 60-day lock or longer than that. It's just too cost prohibitive for them to even guess what's going to happen 60 days down the road from now. So
risky.
Yep.
Very risky.
And hey, one significant point to make, because I think it's lost on a lot of you veterans in here, is we're not a community of just brokers, right? I told you there were different lanes. We have people in every lane. We're not absolutionists, guys and gals. If we were, then when there were really volatile market changes like we saw a year ago, and a lot of people dropped or didn't provide the same access they previously did to loan products, right? You wouldn't have options, and I wouldn't have anyone to speak to it in a way that helped you and found you where you're at to tell you what you need to do next or consider next, right? And so understand that we're not built the way that a lot of people kind of come at me. So maybe that's why I handled that question a little awkwardly. Myself personally, I own a company in that lane, but I don't work with vets in here anyways, right? That's just my personal business choice for my size, scale, operation, what we do, how we do it, all of those things considered, right? It's not to say that I'm better than, say, Jason York, a buddy of mine that's in here. I mean, I wouldn't argue that I'm not either, but I'm saying it doesn't work that way. So understand that we're built differently. We have not only every type of origination channel entity, professional in here, and individuals, right? Not companies, but real estate agents, processors, underwriters, account executives. We have a lot of different people that test through and go through the same basic movements to ensure that they know the things that are appropriate to help you when you find an obstacle in your way, right? And we all work together toward that mission regardless of where we come from. Sound familiar? It ought to. Like, that's why we do it that way. So anyway.
Well, Hammer, I appreciate your time. Appreciate doing this. And looking forward to next week and kind of what happens after this week and doing a recap on that one. It's going to be.
Do you want a crystal ball it by next week? What you're going to be saying next week and what occurred?
Yep, I think next week we're going to look back and say, I sure hope you locked in interest rates because they're a little bit higher. So being next week, I think we'll see rates that are a little bit higher. And our 2 danger days this week are definitely Wednesday and then on Friday, because we get what's called jobs data on Friday. And again, I had mentioned to you guys, the Fed, their mandate is about employment and about inflation. Employment, all that data is coming out on Friday, and that's another day that can have a big effect on interest rates. So if we make it through the Fed and we breathe easy, don't get too relaxed about it, because Friday could be another day where we see that. So my crystal ball says next week rates are going to be at least slightly higher or worse rebate pricing than what we see today.
So on Friday, good or bad, what are we supposed to look for? What tells us it's good? What tells us it's bad? It's bad.
So for the sake of mortgage rates, not necessarily the whole economy, but for mortgage rates, if jobs were to be weak, that would be good for mortgage rates. But right now we know there's a labor shortage. There's, more jobs than people. So job creation is probably going to be pretty high. And that means that would be bad for mortgage rates, but good for our economy as a whole. Also wage data, wage inflation. Wages are going up. People are getting paid more. And that's fantastic. So, but also for mortgages, it's not necessarily a positive, even though it's a positive for people's pocketbooks. And that's what we're going to be watching for. So if you saw what they call a miss, or if you saw very weak data. It almost sounds
like you said as soon as the wages start to get ahead that they adjust the scale a little bit.
That the inflation is going to go with it. Unfortunately, you make a little more and you're just a pass-through. It goes out the other side. But at least we're not seeing the inflation without the wages right now. So that would be even worse.
That hits renters a lot harder. For those of you, ladies and gentlemen, that are out there renting and that are watching this, when that period that we're kind of talking about and that aha of, as soon as wages start catching up, you'll see other stuff start changing, right? It's going to hit renters a little bit harder. The people that have bought and purchased with fixed payment metrics on the principal and interest because of their fixed interest rates, right? They're going to have more of a fixed mortgage, homeowners insurance, and property taxes may increase a little bit, but their overall cost for housing is going to remain more in place than a renters may during that type of time period. Because keep in mind, investors still have to make a profit, or else they're not investors, right?
Yep.
And right now, you don't just have mom and pop individual investors, you have international investors, right? National companies going after it all. So pay attention, stay frosty. Hammer done dropped some good hammer time, I think. Anything else for the ladies and gentlemen before we part?
That's it for me. I think we've covered everything.
Cool. So if you had a question, you didn't ask it, like, come on, we told you, ask your questions, because we want to make certain that we're taking time to find you where you're at, those questions, wherever they are, and speak to them specifically so you can come away a little bit ahead of the game.
Yep.
Y'all have a great week.
Hammer? I say next week we'll be here at the same time, and we can look back and we'll be able to compare what we talked about today and how accurate were we. So anybody that's watching today, if you're watching on the replay, you can join us live next week at the same time.
Yeah, and if you watch the replay and then you watch the other replay and you have an opinion about how the things go, throw up a hashtag replay or whatever to let us know, and we'll comment too. But we want to continually understand what y'all's shortcomings are and informational intelligence that you need so that we can find people to bring it on and speak to it directly for your benefit. So hit us up, ask those questions. Until next week, guys, stay frosty.